Today I wanted to share with you an interesting situation we came across, and I think it's a great example of the benefits of tax planning and proactive tax planning, which is something we do with all of our business clients. And a lot of small businesses and smaller taxpayers think that tax planning and tax strategy is the realm of larger business, and that that maybe the value and the tax benefits aren't there for them. But this is a great example that even when you're pretty small, you can still save tens of thousands of dollars in tax if you have an active tax strategy in place, and obviously you're working with the right advisor. So I'll give you a bit of an example here. We had a client recently, as a new client for the first time. So previously it was done by the previous accountants. Small little consulting company, had done well, a couple of $100,000 worth of income, and almost all of that was profit. So company tax bill in the order of 50 grand, which is roughly 26% of that profit. So that's all fine and good. We look at the individual's previous year's tax return that the prior accountant had done, and there was about $130,000 in carried forward non-commercial small business losses, and they are losses from the small side business that this particular individual had, because the law for individuals says that if you don't get at least 20 grand's assessable income out of your small business, and if it happens to make losses, they get carried forward until you do hit that trigger point of $20,000 assessable income, at which time you can claim those losses against your other income in your individual return. And this particular individual obviously hadn't met that trigger for many years, and had about $130,000 or so of carried forward non-commercial losses from this small little business. We saw that. We saw the potential for paying out a fairly large franked dividend from her company, which had company tax credits associated with it. And we advised that individual that if they could meet the $20,000 assessable income test in the next financial year, so they just worked particularly hard with that little side business, compress some sales in that year, and get over that hurdle of $20,000 assessable income, then that would bring forward our ability to claim that entire $130,000 loss against a $130,000 franked dividend that would come out to that individual. And the effect of merging those two things together in 1 year for that individual is a tax refund of at least somewhere in the order of $30,000 of tax credits that would have been locked away, and probably not refunded, certainly at that level. And also we've been able to utilise those losses. And that all came about because we were actively looking at the circumstances of that individual. We looked at their history, and we obviously, quite within the bounds of the law, looked at ways that we could take advantage of the tax law and get the best tax outcome for that individual. So there you go. There's an example, a pretty small little operation, tax benefit somewhere in the order of $30,000 just by going through some proactive tax strategy and tax planning with us. And so if you're one of those taxpayers out there that thinks that tax planning is not necessarily valuable to you, I would ask you to give that a bit of a second thought. Speak to your accountant, make sure they can obviously do it, and give it a go, because like this taxpayer, you may find that there's some really pleasant surprises if it's done well. Until next time, we'll see you then.